Welcome to this edition of Fixed Interest, where we will be discussing President Trump's policy agenda and the outlook for U.S. public finances, debt, and the U.S. sovereign ratings. My name is Shelly Shetty, and I'm a managing director and head of Americas and Asia sovereign ratings at Fitch. Joining me today is Richard Francis, who's the co-head of the Americas and also the primary analyst for the U.S. sovereign rating. Now, as you all know, on January 20th, President Trump was inaugurated, and shortly thereafter, a slew of executive orders were signed. Some of President Trump's key economic areas of focus include tariffs, immigration, tax cuts, and deregulation. While tariffs have not been announced so far, we do expect tariffs to be imposed eventually. At the same time, we do expect the 2017 Trump taxes to be extended with additional cuts possible. Now, all of this comes against the backdrop of already high fiscal deficits and elevated and rising debt burden. And also to note, Fitch affirmed the U.S. rating of AA+ with stable outlook in August of last year. So really lots to discuss here, and let's jump right into it. So Richard, President Trump was inaugurated on January 20th after winning a decisive election with a popular majority. Also, the Republican Party controls both houses in the Congress. So what are the key agenda items for the president in the first 100 days, and which ones will you be paying close attention to?
So Trump was inaugurated a few days ago, and he came in with a significant number of executive orders. So, already movement going on in the Trump administration. He announced the withdrawal from the Paris Accords and from the World Health Organization. He declared a national emergency on the border, which will allow him to deploy troops and access funds to build a wall. He's declared drug cartels terrorist organizations. He's declared a national energy emergency, which rescinds Biden-era protections for fossil fuel extraction. One thing he did not do is he did not announce new tariffs, but since the inauguration of the last few days, he has pledged to introduce 25% tariffs on Canada and Mexico and 10% tariffs on the EU and China beginning on February 1st, so just within a few days. So a number of things are going on. We'll have to see the other items, the key items on the agenda for the next 100 days will be what happens with deregulation, what happens with border security, deportations. We'll have to see what the economic and fiscal impacts of those will be. The debt ceiling suspension ended on January 2nd, and it's become binding this week, actually. And we'll have to see what the Congress does in order to either lift or suspend again the debt ceiling. The good news on that is it does appear that they have a pretty significant cash balance at the beginning, and we expect tax revenues to rise in April. And then we'll have to see what happens with the continuing resolution that was introduced in December. It expires on March 14th, so we'll also have to see how that's resolved. And then lastly, we'll have to see how the appropriations bills go through. Probably we'll see another continuing resolution on March 14th, but see how those are resolved as well, and including the tax cuts, the extension of the tax cuts.
Thanks, Richard. Obviously, a lot's going on, but let's shift our focus a bit to public finances and the outlook there. What are your expectations for the fiscal dynamics in the U.S. under the Trump administration? And also, have you really changed your fiscal deficit projections, since the elections? And how do you see the main downside risk to your fiscal projections?
Yeah, since the election, we haven't really changed our underlying fiscal projections. We were expecting a little bit better fiscal outturn this year in 2025, given just the fact that we expect, some improvement in tax revenues, given the really tremendous stock market last year and higher economic growth, that we saw as well. Which will boost revenues. And additionally, we are expecting some additional revenues to come from tariffs. But the underlying deficit we see at about 7.5% of GDP at the general government level, which includes state and local governments, both this year and next year. So not much change going forward. We always thought that the 2017 tax cuts would be made permanent. That's still our base case, and it seems like, with the Republican control of the Congress, that's likely. I mentioned tariffs. We do think they'll provide some additional revenues, but it won't be enough to offset possible further tax cuts in addition to tax cuts that we already have put in. Trump has said that he doesn't want taxes on tips. He doesn't want taxes on Social Security. He's mentioned, perhaps cutting corporate tax rates further. And it seems also there's gaining momentum, in order to get these cuts through, to relook at the SALT deductions. So there could be increases in the SALT deductions as well. Of course, we there are some uncertainties. They have announced that they want to look at spending cuts. There are talks in the Congress right now of maybe putting cuts to Medicaid, which actually could move the needle on the spending side. So that could be a benefit, and we don't know the extent of the tariff increases as well. So there might be some offsetting measures, but for now, we don't see much room. And I think that's underscored by the fact that only 15% of the budget is in non-defense discretionary spending. So there's very kind of limited room make tremendous cuts to the budget, we feel.
Okay, that's really a perfect segue to discussing public debt dynamics in the US. So, could you talk through a little bit about how do you see the US debt trajectory and also how higher bond yields, despite the cuts that we've seen from the Fed, might impact the US debt trajectory and also the interest burden?
Yeah, I mean, obviously these relatively high deficits are putting pressure on the debt trajectory. Currently, we see debt to GDP at the general government level reaching 120% of GDP by 2026. This is more than double the double A median, actually. And in our base case, we did see the interest burden actually falling a bit, starting next year. This is just given the fact that we were and still do think that there will be significant cuts in interest rates. I think obviously there's a lot of uncertainties around that. We've actually seen the 10-year Treasury yield actually rise since the Fed began its interest rate cuts. And I think there's still some uncertainties even on the pace of the interest rate cuts. We're expecting 100 basis points cuts this year, but I think given the fact that some of the measures that Trump is putting in could be actually beneficial to growth and also could be negative for inflation. So I think there's some uncertainties of whether those 100 basis points will actually happen. I think there's some downside risks to that. So I think, but the bottom line is, I think there are some risks that the interest burden could stay elevated. And again, the interest burden is over three times the double A median.
Okay, so what you're telling us is that deficits are high, debt is elevated, and it's rising. And also, it seems that the US is confronting some long term spending pressures from adverse demographics. As such, entitlement reform is a significant need in the US, and yet it really wasn't a major topic during the election. So, Richard, what are your expectations for entitlement reforms that can curb the expected increases in Medicare and Social Security costs?
Yeah, I mean, I don't think there's much political appetite across the political spectrum, both on the Democrat and on the Republican side, to really tackle the issues from an aging population, specifically in the area of Social Security and Medicare. It is a growing burden on the government's budget. The Congressional Budget Office projects costs to rise by nearly 2 percentage points of GDP over the next decade. Obviously, that's coming on top of an already very large deficit. So just going to put further pressures on the budget going forward. The CBO also projects that the Old Age and Survivors Insurance Trust Fund, a part of Social Security, will be exhausted in 2033. That's less than 10 years away. And also the Medicare Hospital Trust Fund would be exhausted in 2036. So, more or less a decade as well. So that just kind of underscores the pressures that are facing us over the next decade. The Social Security fund is depleted. The estimates are they would have to make cuts across the board of about 20%. Obviously, not a very politically popular thing to do. I guess the good news is there is a history of tackling issues, usually at the last minute. The last time the Social Security fund was going to be depleted within 2 years was in 1981. The Congress actually set up a bipartisan commission to make recommendations to Congress, and Congress actually acted on those recommendations. And So there were significant changes in 1983 to the Social Security Fund, which actually extended the life for 50 years, which is why we're only beginning to talk about the exhaustion of Social Security in the next decade. So there is a history of the Congress acting, but usually at the last minute.
So, despite the long term challenges and rising debt in the US, which you just discussed, Richard, we still do emphasize the tremendous financing flexibility of the US, which really is underpinned by the reserve currency status of the US dollar. So, what are your views on the risks to this status?
The reserve currency status of the US dollar is still a key strength of the US sovereign rating. It is the preeminent global reserve currency. It still represents nearly 60% of all international reserves in the world. And we don't really think that there's any immediate challenge to the US dollar. The second currency is the euro, but the euro suffers from a lack of fiscal policy response, coordinated fiscal policy responses. Many of the members have very high debt levels as well, such as France and Italy. So not an obvious choice. It is a choice, but it's not as strong as the U.S. dollar. China is only represents about less than 5% of global reserves, and obviously it has capital controls which are significantly limited. It is an option, and now it's also suffering from its own fiscal challenges as well. The share of the U.S. dollar has actually fallen over the last 2 decades or so, but from 70% to below 60%. But much of that has been due to the diversification into smaller currencies such as the Canadian and Australian dollars. I think over the longer term, we could see some challenges to the US dollar, um, but probably mainly due to technological advances, such as the creation of alternative payment systems. China has created a cross border interbank payment system to kind of get around US sanctions for the likes of Russia and kind of trying to get other BRICS to enter that. And this increasing use of U.S. sanctions, could kind of make those alternative systems even more important, and kind of reduce the dollar's reserve currency status. And I think just more generally speaking, another trend that we have been seeing is an increase of gold holdings as an alternative to the U.S. dollar, but that still is not a very significant portion if you look at the total of reserve currencies. So, in the near term, not any challenges, but over the longer term, there could, challenges could build.
So let's pivot to talking a little bit about the U.S. rating. As you all know, Fitch did downgrade the U.S. rating from AAA to AA plus in August of 23. So, Richard, maybe you can remind us of the reasons for that downgrade, but really emphasize a little bit on how things have evolved since then, and also how much headroom do you see in the current AA plus rating, and also what are the main rating sensitivities that could lead to a positive or a negative rating action on the U.S.
Yeah, I think that there are two key factors behind the downgrade in 2023. One was, just this deterioration in governance that we feel like we've been seeing for 20 years or so, and especially on fiscal policy matters. We've seen repeated instances of brinkmanship over the debt ceiling, difficulty in passing budget appropriations on time with threats of government shutdowns, obviously the inability to arrest the continued rise in the debt to GDP, and, as we just talked about, the looming challenges of an aging population and the challenges facing Social Security and Medicare. So all of these things have kind of led us to believe that there's been a deterioration in governance and especially on fiscal matters. I think the second part is obviously just these high fiscal deficits that are leading to an increased debt to GDP ratio, and as I mentioned, it's already significantly above the double A, let alone the triple A median. I think, going forward, what we'll be looking for is, just the ability of Congress and the government more generally to reduce the fiscal deficits over time. And, I think that's a key factor that we'll be looking at. And, also the ability to tackle these long-term challenges, which I just mentioned, Social Security and Medicare. If for whatever reason we don't see any improvement and debt to GDP continues to rise, that could lead to a negative action. I think furthermore, if you saw a loss in the credibility in policymaking of the US government that would undermine the reserve currency status of the US dollar. That could be negative as well. And, I think that one risk for that would be the debt ceiling debate. And if they weren't able to raise or suspend the debt ceiling and they started having to not make payments on their obligations on time, that could be negative and it could probably lead to that deterioration in credibility. On the other hand, if we do see a significant reductions in spending or some kind of increases in taxes that kind of lead to a significant reduction in the deficit, and we start to see at least debt to GDP stabilize, I think that would be positive. And I think that would also kind of signify that we have some kind of improvement in governance because the Congress is making the difficult decisions, and especially if they're able to tackle the long-term issues on Social Security and Medicare.
Great. That's a wrap for us. Thanks a lot, Richard, for your insights. Thank you for listening. And more on the US, you can access our research on our website, fitchratings.com. Hope you will join us in the next Fixed Interest podcast. Thank you.